Hello, students and teachers, and today what I want to talk about is the overall news and how it affects the markets. And for example, we're just coming off the caucus from Iowa, and we have, of course, Cruz is one for the Republican Party, and the Democrat was pretty much a flat-out break even. But really, when we talk about news, most news in today's markets is already priced into the markets. So if you think that there's going to be something that has great news, most of the time that's already been priced in to a market overall. If you think it's going to have bad news, most likely that's already been priced in the market. What we mean by priced in, the market builds in certain expectations. And especially in today's world with all the technology and all the fast news flowing all over the place, you get news much faster, so very sharp people can make a better assumption on what the earnings are expected to be or what this announcement is supposed to be. So markets build in these price expectations, so when you get a great number that you think is, oh my God, it's unbelievable, and the stock should go straight up, well, the stock falls straight down because it had already pre-rallied into that. So what you want to look at when you take a look at your charts is you start to see news coming out, or we have an earnings event coming out. So we know that ABC company has earnings on Thursday. We want to look at ABC, and if we see the chart is spiking to newer highs, probably it means that they're pricing in good news. Now, can the news be better than they've already priced in? And typically the answer is no. And I think nothing more important will show than, for example, this Friday's jobs number comes out. The jobs report is a monthly report that's one of the biggest economic pieces of data that we're looking for. Now, they'll price in a move, but if the move is not as good as they think or worse than they think, the market will go the opposite way of the way that it's been priced in. So what you want to watch for is just look for market expectation and look for to fade the market of the expectation, because typically expectations like hope usually run a little bit too far to one way. So typically we'll want to go the other way. So as we look at it, look at the chart. If you see a chart that's tanking, coming into an earnings report, you may want to think about buying it. And if you see a chart that's going straight up into an earnings report, you might want to think about selling it, because again, market expectations have a very funny way of overshooting the mark and then it down. This is Todd Bubba Horwitz from highschoolinvesting.com, coming to you from the floor of the CME Group in Chicago.